Nearly every financial expert you see online repeats the same guidance about Social Security. Wait until age 70, grab that 8% per year delay credit, maximize your monthly check, and whatever you do, absolutely positively do not file at 62 because you will supposedly give up $246,000 in lifetime benefits. That is the mainstream script. That is treated like the sacred rulebook of retirement planning. And for a huge portion of American retirees, that rulebook is both mathematically and strategically wrong. In this video, I am going to walk you through 7 specific scenarios where filing at 62 is not a blunder at all, but actually the smartest financial move a retiree can make. And here is what makes this video different from almost every other Social Security video on YouTube. Most of those videos are made by financial advisors who charge you fees to manage your investments. They have a powerful incentive to nudge you into delaying your Social Security because the longer you wait, the longer they are managing your other assets. I do not manage investments. My work with retirees is focused on the tax side. And what I see, week after week in real client files, often completely contradicts the standard guidance. The retirees who delay Social Security to 70 in the wrong circumstances end up paying tens of thousands more in federal taxes over their lifetimes, get bumped into higher Medicare premium surcharge brackets they never saw coming, and blow the single best Roth conversion opportunity they will ever have. The retirees who file at 62 in the right circumstances use those early benefits to fund tax strategies that legally save them $200,000 or more in lifetime taxes. That is not a theory. That is what the numbers actually show when you run them for a real household. Reason number 1 is going to surprise you, because almost no advisor ever talks about it publicly. Reason number 2 is the trap that snags people who lost their jobs in their early 60s. Reason number 3 is tied to family health history and is something every retiree should run the math on. Reason number 4 applies to married couples where one spouse significantly out-earned the other. Reason number 5 is for retirees who still have minor or disabled children at home. Reason number 6 is for divorced retirees, and almost half of you watching this will qualify without realizing it. And reason number 7 is the one every retiree under 65 needs to weigh carefully because it involves what is projected to happen to Social Security in 2034. My name is William. I am an enrolled agent, which means I am federally authorized to represent taxpayers before the Internal Revenue Service. I spend every week working with retired clients on the tax implications of when to start Social Security. Before I unpack the 7 reasons, I want to tell you about a couple I worked with last year because their situation is the perfect counterexample to the delay until 70 rulebook. Once you see what they were able to accomplish, you will see exactly why the standard advice so often fails. Robert and Joan are both 62. Robert worked 34 years as a mechanical engineer at a manufacturing firm in Indiana. Joan spent 28 years as an administrator at a hospital. They both stepped away from work at 62. Together, they have a large pre-tax individual retirement account balance of $950,000. They do not receive a pension. They own their home outright. It is worth about $320,000. And when they first met with me, 2 different financial planners had already told them to delay Social Security until age 70. Both planners gave the same explanation. If they wait until 70, their combined Social Security payment would rise from roughly $3,700 a month at 62 to roughly $6,500 a month at 70. Over a 30-year retirement, that delay bonus would be worth more than $240,000 in extra total benefits. Here is what neither planner brought up. From 62 to 73, when required minimum distributions begin under current law, Robert and Joan have an 11-year window where their taxable income will be lower than at any other time in their lives. No W-2 wages. No pension income. Just a modest Social Security benefit if they choose to file plus whatever they draw from their traditional individual retirement accounts. If they defer Social Security to 70 and live entirely on withdrawals from those accounts between 62 and 70, they will deplete $300 to $400,000 of retirement principal during the lowest tax years they will ever have. Then at 73, they start required minimum distributions on what is still a sizable pre-tax balance, and those forced withdrawals, stacked on top of full delayed Social Security benefits, shove them into a higher tax bracket for the rest of their retirement. On top of that, they will trigger higher Medicare premiums through income-related monthly adjustment amount brackets, commonly called IRMAA, adding roughly $4,000 to $7,000 a year in extra Medicare costs for life. The alternative I showed them looked like this. Start Social Security at 62. Use those earlier benefits to pay most of their living costs. Then, instead of pulling traditional individual retirement account funds as taxable income, start systematically converting those dollars into Roth individual retirement accounts each year, intentionally filling up the 12% federal tax bracket from age 62 through 73. Pay tax now at the lowest rate they will likely ever see on money that would otherwise be taxed at 22% or 24% or even higher once required minimum distributions begin. Shrink their future required minimum distributions. Shrink the portion of Social Security that will be taxed in later years. Shrink their future IRMAA surcharges. And leave their heirs a Roth individual retirement account that grows tax-free for as long as they live and passes to their beneficiaries without a built-in tax bomb. When we projected the numbers through age 90, the file at 62 plus Roth conversion strategy cut Robert and Joan's lifetime federal tax bill by about $220,000 compared with the delay until 70 strategy, even after factoring in the smaller Social Security check. That $220,000 tax savings effectively outweighs the supposed $240,000 benefit from delaying. And that is before we even consider the possibility that one of them dies in their 70s, shutting down the Roth conversion window early and turning the delay to 70 strategy into a disaster for the surviving spouse. This is the kind of story almost no Social Security video on YouTube walks you through because, to explain it clearly, you have to understand the tax code as deeply as you understand the Social Security rules. So, with Robert and Joan's example in mind, let me walk you through the 7 specific reasons every retiree should at least consider filing at 62. Reason number 1, the Roth Conversion Runway. I am starting with this because it is the single biggest tax planning opportunity most retirees in America are currently missing. It is also the one that almost never gets airtime in other Social Security videos. The federal tax system rewards retirees who can keep taxable income modest for several years in a row. The years between when you leave your job and when required minimum distributions start at 73 are usually the lowest taxable income years of your adult life. If you can cover those years primarily with income that is lightly taxed or partially tax-free, you create a huge opening to convert pre-tax individual retirement account balances to Roth at the 12% federal rate, instead of being forced to take those same dollars out later at 22% or more once required minimum distributions begin. Filing for Social Security at 62 can provide that low-tax stream of income. You use Social Security plus a modest level of taxable withdrawals to pay your bills. You convert the remaining traditional individual retirement account funds to Roth each year. You steadily drain the future tax burden out of your retirement accounts. You build a Roth account that grows tax-free for your lifetime and then passes to your children without saddling them with a large tax bill. For couples who have more than $500,000 in traditional individual retirement accounts, the math on this strategy almost always shows greater lifetime federal tax savings than the total gain from delaying Social Security to boost the monthly benefit. Almost always. And hardly anyone mentions it because most people outside of tax professionals do not even realize this runway window is there. Reason number 2, you are already out of the workforce and spending down your retirement savings. This describes a huge group of retirees who were laid off, pushed out, or simply burned out in their early 60s. The standard advice they hear is, just live off your savings, pull from your retirement accounts, and hold off on Social Security until 70. From a numbers perspective, this recommendation often fails badly. Every dollar you take from a traditional individual retirement account between 62 and 70 shows up as ordinary taxable income at your full marginal rate. Every dollar of Social Security you receive between 62 and 70 is at most 85% taxable and often less, depending on how much other income you have. And those Social Security dollars are never subject to FICA payroll taxes. If you are draining your individual retirement accounts anyway, you are paying full ordinary income tax on each withdrawal and also losing the combined advantage of having Social Security benefits arriving alongside those withdrawals. In most cases, The more efficient move is to start Social Security at 62. Reduce how much you must take from your individual retirement accounts by the amount your Social Security benefits cover, and allow as much of your invested retirement savings as possible to continue compounding in the market. The growth on the portion of your nest egg you avoid spending down often surpasses the lifetime value of the delay credit on your Social Security benefit. Reason number 3. Your family history suggests a shorter life expectancy. This is the factor that even many conventional planners will admit matters, but they rarely sit down and run the precise break-even age. Social Security is fundamentally an annuity-style program. The longer you live, the more cumulative dollars you receive. The shorter your lifespan, the fewer dollars you collect, regardless of your monthly amount. For someone born in 1960 or later, the break-even point between filing at 62 versus filing at 70 generally falls around age 80 to 82, depending on how you model inflation and cost of living increases. Live beyond roughly 82, and delaying tends to win in total dollars collected. Pass away before around 80, and filing at 62 usually wins. Here is what almost no one tells you. Based on the Social Security Administration's own actuarial tables, the average life expectancy for a 62-year-old man is about 81. For a 62-year-old woman, it is about 84. That means for roughly half of male retirees, claiming at 62 is mathematically favored just using average life expectancy. If your father passed in his 70s, your grandfather died in his 60s, and most male relatives are not reaching their early 80s, the longevity math tilts strongly in favor of filing early. Reason number 4. You are married and your spouse's earnings were much lower than yours. Social Security includes a feature called the spousal benefit. If your spouse spent much of their life earning less than you, took extended time out of the workforce to care for children, or primarily worked part-time, their own benefit at full retirement age may be well under half of yours. Under current law, that lower-earning spouse can receive a spousal benefit equal to up to 50% of your primary insurance amount once they reach full retirement age. But there is one critical requirement. They cannot collect those spousal benefits until you have filed for your own benefit. If you postpone your own claim until age 70, your spouse is locked out of spousal benefits until then. In marriages where one spouse substantially out-earned the other, having the higher earner file at 62 can unlock years of spousal benefits that would otherwise be lost. Over the 8-year stretch between 62 and 70, those additional spousal payments can add up to $70,000 to $150,000, which often more than makes up for the somewhat smaller monthly check the higher earner accepts by filing early. Reason number 5, you still have minor or disabled children at home. This is one of the least discussed Social Security provisions, and it is extremely important for retirees who had children later in life, are raising grandchildren, or have an adult child with a disability that began before age 22. Once you file for Social Security, each minor child under 18, any child up to age 19 still in high school, or any age child who became disabled before 22 may qualify for a dependent benefit equal to 50% of your primary insurance amount. There is a limit known as the family maximum, usually between about 150% and 180% of your primary insurance amount. But for a retiree supporting 2 minor children, that family maximum can translate to an extra $24,000 to $30,000 a year in dependent benefits every year until those kids hit the eligibility cutoff. If you wait to claim until 70, you forfeit each of those years of dependent benefits during the gap, which can easily add up to more than $150,000 in lost income for the household. Reason number 6, you are divorced, your former spouse earned a high income, and you were married at least 10 years. This is the rule that nearly half of eligible divorced retirees are unaware of. Under federal law, if you were married to your ex-spouse for 10 years or more and you have not remarried, you may be eligible for a divorced spouse Social Security benefit equal to as much as 50% of your former spouse's primary insurance amount at their full retirement age. Your claim does not reduce your ex-spouse's benefit in any way. They do not have to approve it. They do not have to be notified. If you qualify, the Social Security Administration simply pays you based on your ex's record. For many divorced retirees whose ex-spouse had a much higher earnings history, this divorced spouse benefit is larger than what they would receive based solely on their own work record. Filing at 62 instead of waiting can add tens of thousands of dollars in lifetime income that would otherwise go unclaimed. If you are divorced, were married at least a decade, and have not remarried, you should call the Social Security Administration to ask specifically whether you qualify for a divorced spouse benefit. Reason number 7, the Social Security Trust Fund is projected to be depleted by 2034. This is the factor that every retiree under 65 needs to think about, because it comes directly from the official annual trustees report. It is not rumor or internet speculation. According to the most recent report, the Old Age and Survivors Insurance Trust Fund is expected to run out of reserves in 2034 if Congress does nothing. At that point, existing law allows Social Security to pay benefits only from incoming payroll taxes, which the trustees estimate will be enough to cover about 77% of promised benefits. In practical terms, that means an automatic 23% across-the-board cut for everyone, whether you have already claimed or not. So a retiree expecting $30,000 per year in Social Security would see that drop by about $6,900 annually for the rest of their life. There is no certainty Congress will fix this in time. There is no certainty any fix will preserve 100% of benefits. Under these conditions, the bird-in-the-hand logic tilts toward claiming earlier rather than later, because every payment you receive before that trust fund deadline is a check you have already collected in full. Now, before I wrap up, there is one additional scenario that is the reverse image of the 7 reasons I just covered, and it is the hidden danger for retirees who follow the delay to 70 advice without understanding the tax ripple effects. I call this the tax torpedo, and it is the single costliest trap many retirees encounter in their 70s. Here is how the tax torpedo plays out. If you hold off until 70 to start Social Security, your monthly check will be about 76% larger than if you had filed at 62. That sounds like a clear win. But 3 years later, at 73, your required minimum distributions kick in on every traditional retirement account you own. The combination of a maximized delayed Social Security benefit plus large forced withdrawals from a big traditional individual retirement account balance can push you into a steep marginal tax bracket, cause up to 85% of your Social Security to become taxable, and trigger IRMAA Medicare surcharges that add thousands of dollars to your healthcare costs every year for the rest of your life. The people who get slammed the hardest by the tax torpedo are precisely those who followed conventional wisdom, delayed Social Security to 70, and never shifted traditional individual retirement account funds into Roth during their low-tax window. They walk straight into a tax wall in their 70s, with almost no way to climb back down. Filing at 62 and using the gap years proactively for Roth conversions is the cleanest way to sidestep the tax torpedo altogether. That is why these 7 reasons matter. That is why the usual blanket advice fails for so many retirees. And that is why I want every person watching this to run the full set of numbers, including taxes, before locking themselves into a delay until 70 strategy. To help you do that, my team and I created a free resource called the 2026 Retiree Protection Checklist. It is a 42-page, in-depth guide that walks through the Social Security claiming decision framework we just discussed, the 4 most important timing windows for Roth conversions, the 9 Social Security and Medicare timing choices. Retirees most often get wrong, the IRMAA thresholds and how to stay out of higher brackets, the 7 deductions retirees most frequently overlook, and a complete step-by-step process for shielding your retirement accounts from federal reporting pitfalls and elder financial abuse. There is no cost. It is not a gimmick. It is not a sales funnel. To have the checklist emailed to you, go to roadtostatesegkit.com checklist, enter your email, and the full guide will arrive in your inbox within a few minutes. And while we are on the topic of taking control of your retirement finances, if you prepare your own tax returns, I want you to consider using TaxSlayer. TaxSlayer is the software I personally suggest for clients who are comfortable filing without a preparer. It is noticeably cheaper than the big-name brands you already know. It can handle every tax issue a retiree is likely to face, including Social Security benefits, pension payouts, required minimum distributions, capital gains, and the newer 1099-K reporting rules, and it is supported by a team of tax professionals you can actually call if you need help. There is a link in the description below this video, and using that link helps support this channel without costing you anything extra. Let me finish with the single most important takeaway from this entire video. Choosing when to start Social Security is the largest financial decision most retirees will ever make. Once you choose, you are locking in a lifetime income stream. That choice interacts with your tax bracket, your Medicare costs, how quickly you tap your retirement accounts, and what your spouse ultimately collects in ways that generic online calculators and many generalist advisors never fully model. The stock advice to delay to 70 is appropriate for some people. For many others, it is extremely costly. The only way to know which camp you are in is to run true tax-adjusted projections that factor in the Roth Conversion Runway, the spousal benefit timing, your family longevity break-even age, and the trust fund depletion scenario before you decide. Filing at 62 is not automatically wrong. In the 7 situations we just covered, it is often the most financially intelligent move a retiree can make. The retirees who lose the most money are not usually the ones who file at 62. They are the ones who follow broad, one-size-fits-all advice without checking the math for their specific situation. If this video helped clarify your thinking, hit the like button now, because that is the key signal that tells YouTube to show this information to more retirees who are about to make a permanent Social Security decision and need to see the full context first. Subscribe if you have not yet, because next week I am releasing a follow-up video covering the 3 precise tax strategies every retiree should execute in the year before they file for Social Security, whether that is at 62, 70, or anywhere in between. And if you know any friend, sibling, parent, or neighbor between ages 60 and 70 who has not yet claimed Social Security, send this video directly to them. The decision is too big and too permanent to base on one advisor's opinion or one quick online search. These 7 reasons must be part of the discussion. I will see you in the next Road to States video.